Why would you compare a productive asset to a precious metal? Why wouldn't you? Do you think I do not know that Apple is a corporation and gold is an amorphous substance that can be found on the periodic table, that it's a metal? Do you think that's skipped my mind? Oh, you know what, you're right. I didn't realize. One's a conductor of electricity and one's a Delaware C Corp. Ah, thank you. It's just an interesting comparison. You know, Buffett would argue Apple's way more valuable than gold. Is that what you pay for, Mick? I don't think so. I don't like that framework. So like people say that about Bitcoin, like, okay, it costs a lot of money to make Bitcoin or to mine a Bitcoin or whatever. There's proof of work. I don't think that's a good thing. Why is that a good thing? Imagine if the same thing was required of TCP/IP. I don't know why people find gold valuable, but it is a societal thing, and it really is a truism of the price of something is whatever people are willing to pay for it, which juxtaposes against the value of things. And this is a forever tug of war that you have to keep in mind. And this is why being a good investor requires flexibility. The price of something and the value of something are constantly in conflict. And you have to be able to accept both concepts. Gold is practically worthless compared to its current price. At the end of the day, we've accepted that the value of gold is low and the price of gold is high due to either some perceived scarcity or whatever. And it just is what it is. Like, you just can't change it. We have to accept it. You know, it'll never change. And, you know, of course, it's sometimes seen as a hedge against inflation or fiat or whatever, but I don't think gold's necessary. That is a very interesting point, 𝗤𝗏𝗘𝗀𝗕. I like that. Gold is a Ponzi. You could also call it a corner, if you're familiar with that term. It's a corner that is perpetrated by central banks. I'm usually not a conspiracy theorist, but I kind of like this idea because corners are illegal when you or I do them. If we bought all the shares of some small cap stock and tried to make it go up by not selling it and made it go to a 10 trillion market cap, that's a corner and it generally is illegal. But if the central banks did that with gold, well, they made the rules. So yeah, I mean, look, you know, there is something real about gold that has lasted millennia that paper money hasn't, although we've had paper money for a while too.
Gabriel asks a simple question: why can't you go long the strangle every time there's a biotech clinical trial announcement? Well, as I've said, if I ever get a tattoo, never done, I never will, but if I ever get a tattoo, it would just simply say no arbitrage or no free lunch. The reason you cannot just simply make free money in the stock market is because people price the options at a price that's prohibitive. In fact, they'll price them so aggressively, you may want to short the strangle. That's kind of the point. You know, there is no free lunch.
And again, you know, really short period of time here, just 7 years going from 600 in revenue to 9-10 billion in revenue, and managing through that, not very easy. Again, if you look at and think about what does it take to be successful in business and life as an entrepreneur, as an investor, whatever, be cognizant of the fact that here these guys in the e-commerce trend was fairly evident, right? By 2008, you probably knew you have to be sort of stupid to not see that e-commerce was going to replace most of commerce. It's going to go online. And that in 2015, this was a very young company at 200 in revenue, and a whole lot. You know, 5 years prior to that, I don't even know if they were maybe just launched. So you don't have to be early to a trend. There's this pervasive belief that you have to be first to a trend, and it's just not true. You know, e-commerce was this huge phenomenon, and this company wasn't exactly early to it, but said we need to make tools that'll enable anyone to do e-commerce. And that's what they did, and look at the rewards. It's a $100 billion company. And they were certainly, you couldn't say they were first to the party. I think maybe they were one of the first to the idea that they should enable others to make their own to make tools to help people make their own systems to do e-commerce, so they could focus on their store and customer acquisition, and they're focused on their product, I should say, and not focused on the technology side of things. Whether you're selling t-shirts or whatever, you know, they've grown from 200 million in revenue just a decade ago to 10 billion. Really remarkable. And I would never say that it's easy. I'm sure other people wanted to do this and tried to do this and failed. So don't mistake this for being easy, but they certainly, along the way, I'm sure they learned lots of things about business and this business in particular, and, you know, what customers wanted and needed and things like that.
I think it depends, Sebastian, what you're trying to accomplish. I mean, in high finance, the idea of a Sharpe ratio is that you can gear or leverage any alpha and beta into whatever return profile you want, right? So fund manager has 10% annualized returns and 4% annualized volatility. Let's look at this real quick. So let's say their return, I don't know, let's call that mu, is 10%, and their vol, we'll call that sigma, is 4%. This is a much, much better fund, okay, than the fund where mu is 22%, which is, wow, that's a lot of outperformance, right? But the sigma is, say, 25%. Because this guy is basically never down, right? So let's say you levered him up 3 times or 2.5 times. You would now have 25% performance, but only to 12% vol, right? So he's got the same returns as this guy, but half the volatility. All else being equal, you want this guy. Position sizing is somewhat indirectly related to this, but it does help you control variance, at least, the volatility. There's a lot of things to think about when it comes to position sizing. You know, we've talked a bit about Kelly criterion, which is probability of right. It's a Bell Labs equation minus the probability of being wrong. Pretty simple equation. So if you think you're 80% right, this is not return adjusted, by the way. So it's not expected value adjusted. If you have an 80% chance of being right on, say, a binary event, you should have a 60% position. But Kelly tends to overestimate. So in any event, there's a lot of ways to do it. There's another ways to gear towards max drawdown. So it actually doesn't matter. We've done the historical return histogram where, you know, if you have a 5% position on a stock where the 1 sigma is 15%, I mean, you're basically saying you're willing to have even just this one component of your stock portfolio is going to contribute possibly as much as 1.5% in daily volatility. That's a fairly big result, right? Imagine your 5% stock is in your favor by 15% or against you by 15%. Your portfolio is going to change by as much as 1.5%. Did I get that right? Or is it 75 basis points? At least that's just on 1 sigma. It could be, now no stock has a 1 sigma of 15%, but 2 sigma for IonQ is 15%. So, you know, your portfolio will change 1% possibly a day just for any old reason. So many different ways to think about it. You're really asking a fundamental investing question. Maybe one of the videos that I'm going to make will do a better job on this than off the fly. Yeah, Jordan, you know, some people want that. Some people want a 5-10% daily change in their portfolio. That's a little crazy. And I certainly don't think you want that in the long run. But that's also where the Sortino ratio comes in. You shouldn't really mind upside volatility, right? You should really only want to avoid downside volatility. Now, the two tend to go hand in hand. Oh yeah, I'm very close to recording the first investing lesson. It's going to be pretty well produced, I think.
This is a debate that's not going to be solved right now. You know, like, it is one of these really age-old debates. The silver market was cornered by that's right, by the Hunt brothers. I met one of the Hunts in Dallas, one of the Hunt, I guess, probably grandsons. And because of that corner, the rules got changed. The Volcker created a futures limit rule. Before that, there was no futures limit rule. People like Hunt and me, unfortunately, our minds won't stop working. And we'll constantly think, well, there's a limit on how much stock you can buy, but there's no limit on futures. Let's buy all the silver we can. And that, you know, people who are creative or have a lot of ingenuity sometimes will sort of skip the common sense part of things. Like, it doesn't make sense to actually do this. And some people just do it. And I don't know that that's necessarily a good thing. But, Hunt's tried to corner gold and it failed. And I think they had some issues after that. There was a platinum trades failed in the metals market. So there was that too. Yeah, gold had a very specific physical property that allowed it. For example, you can test the density of gold very easily. It's very specific weight, and therefore is like perfectly good kind of tool. So I don't know. I feel like it's interesting to compare asset classes because it gives you a barometer for what's back to the serious, maybe more serious question. Why compare equities to commodities? Well, it's a very philosophically interesting thing to do. So real estate's a good example. I would venture to say that all of global equities should be worth more than all global real estate. I would actually venture to say that some commodities, this is a tough one. I've always thought oil was a little undervalued, but versus gold especially, it's tough to say. There's a lot more interesting investors than Michael Burry out there. We actually make a point of pointing them out on this YouTube. Got to explain to you guys what insider trading is. Here we go. You guys could listen or do some research yourself. That'd be nice. One, the news has to be material. What does that mean? Usually this is interpreted in the framework of a single stock. So it has to be material to a specific security usually. But, the basic test here is a person on the street would agree that it's important news and the stock would move on that news. But there's some people that try to fight material, but it's almost always material. 2, it has to be non-public. You cannot find it on a website like Truth Social. You can find it on a website like Truth Social. It's public. Okay. 3, breach of duty. This is the complicated one. You got to think about this. Did somebody breach the duty to not disclose the information? A CFO has a duty to his stockholders to keep that information private. If an airline attendant heard a CEO talk to a CFO and the CEO says, I'm going to buy out, say it's Satya Nadella talking to Bill Gates, and Satya says we should buy out Adobe. The airplane attendant says, oh, I overheard Satya talking to Bill Gates about Adobe. And she calls a friend, Martin Shkreli, and she says, I really like Adobe, you should buy out of the money calls in Adobe. That is perfectly fine for me to trade Adobe because she's not telling me that she heard it from somebody who has a breach of duty. If she told me I overheard Bill Gates and Satya Nadella talking, I would say, well, there's a breach of duty there. The other thing that's important that the Second Circuit's recognized is there has to be an expectation of profit from the tipper. Now, my suggestion, of course, for anybody considering this type of line of work is to not insider trade. I've never done it, even when these things all lined up, because it's just unethical. But there are many, many close calls where it's not. So let me give you an example of what happened the other day. They could have been planning this tariff move hours in advance, naturally. Well, he was signing his tweet DJT. I think you're just confused there. I don't think he was saying to literally buy the stock DJT. He signs his tweets DJT, which is his name. I don't think he cares about DJT, the stock specifically. That's why there's a comma there. I am ethical. I'm more ethical than you. Let's say they were planning at 9 a.m. to do this tariff planning, okay? There's 20 people in this meeting. And at 10 a.m., a person, witness of that meeting, who has a breach of duty, who has a duty to not disclose secret government information. I'd say there's a duty there. Is it material? Yes. It's material on all equities. Is it non-public? Yes. So the witness calls, a friend, and the friend says, and he says to the friend, he transmits the entire material non-public information. 11 a.m., now he said it was a good time to buy, DJT. He was signing it. He was not talking about DJT stock. And not only that, but he didn't trade DJT stock. So you're just an idiot. If there's a Form 4 filing or a 13G filing where he bought DJT stock, let me know. But he owns half the company, so he doesn't need to buy stock. This is stupid. Okay, so the witness calls a friend. You guys paying attention? The friend, he tells the friend everything. I was in the meeting with Trump. They're going to undo the tariffs, yada, yada. The friend, okay, calls hedge fund manager 1. Hedge fund manager 1 manages a big hedge fund. And he says, the friend says, good things about to happen. Is this material non-public information? Can you trade on it? I think you could trade on this. Friend does not have a breach of fiduciary duty. Is it material? Yes. Is it non-public? Yes. But the chain of the duty has been lost. The friend does not have to keep the secret. At this point, it's a market rumor. And he's not confiding in him that there was the witness had the duty, but the friend did not tell the hedge fund manager where the information was coming from. It was sufficiently vague such that he could tell the rumor. And we don't know how many chains of communication took place before somebody made the bet. Let me tell you something about DC. Things leak like crazy. All people do in DC is gossip. So it would not have been long for people to know what was happening there. People can't keep a secret. So that's kind of how that works. It's not a loophole, it's just a definition of the law. So otherwise, trading on a rumor would be illegal. Somebody said, I heard a rumor NVIDIA is going to buy AMD, and now you can't buy AMD because somebody's made up a rumor. It's nonsense. Now, if that somebody is the CFO of AMD, then they have a breach of duties. Now, they have a duty of care. There has to be some kind of law, so that's how they decided, okay? You don't like it? I don't know what to tell you. That's the law. Correct. The airline attendant would not be allowed to trade because she should know. The CEO and CFO of Microsoft have a duty of care, and that by her overhearing it, she's being exposed to MNPI, where there is a breach of duty. They should not have been talking about that. It doesn't matter if Trump breaches the duty. What matters is who trades on it. You're allowed to give insider info. You're not allowed to trade on insider info. No, I'm saying just the opposite. If it's publicly available commentary that doesn't require private access, then it's not MNPI anymore. It's public. So it's non-public no longer applies. It's public. I don't think you guys should even think about this, okay? There's no point in thinking about it. PE ratio, but that doesn't really mean anything because, you don't have normalized earnings. So in a company that doesn't have normal earnings, PE ratios and price to sale ratios are basically meaningless. You want to do a PE ratio on a number that you believe represents the economic power of the company. And then even if that, like the steady state economic interests of the company, which in a lot of ways we can't really determine that, right? As financial analysts, we try. And one thing you can do is you can kind of cabin it to saying, all right, well, this business they have at least will reach sort of this steady state economic value. This is the earnings it'll produce. And then even if that's 5 or 10 years from now, discount that back. Don't look at today's earnings. That's kind of meaningless, especially if things are moving around a lot. Try to forecast a little, and then when things are steady, take the PE of that and go backwards. That's what finance was created for. In these companies, you really have to think about the long haul because these cycles are pretty deep. Now, on Wall Street, they're watching the near term really closely because they're wondering any demand hiccup. They're wondering if that's the cycle capitulating. So they're watching it like a hawk. And again, theoretically, these guys might see the demand first or last. What do you think? When does Applied Materials, who's more sensitive to demand change? You've got, let's say this is the semiconductor, this is the iPhone, okay? Why, what happened to LVMH? I looked at it for a couple hours. It wasn't. So this is the iPhone, here's Taiwan Semi's fab, and here's Applied Materials. When did they hear about bad demand? Well, think about Taiwan Semi's position. They have to decide when to order new equipment. But they have a ton of customers. They have Apple, they have AMD, they have NVIDIA. So they're trying to size up how's demand going. So if TSM gets bearish and they say, I think it's starting to look frothy out there. I don't know if I want all this equipment. Or if they get FOMO and say, we really need a ton of equipment. And they have orders for $1 billion of semi-cap equipment. And then they say, you know what, cancel that order. These guys hear pretty early. These guys may not hear the music playing, but they give the orders this way. And then TSM says, whoa, we need to cancel that order. I don't think NVIDIA is going to buy as much as they did last quarter or last year of our services, so we don't need more machines. There's an interplay. I think you want to look at all layers. The lead times on this stuff is years, so it's by definition kind of slow. But looking at the bookings here could be very instructive. The revenue is kind of backward looking. It's the bookings that kind of matter a lot. And they're also making multi-year order plans. So even if the iPhone's selling really well, all that fabrication happened a year or two ago. So if AMD says, all right, this is what our chip forecast is going to be, it's going to be down 10%. They feed that to Taiwan Semi, who they have to reserve multi-year capacity for. And then Taiwan Semi feeds that over here to Applied Materials and ASM Lithography. So, yep, I would look at these guys first. Of course, you got to look at everything.